Hello and welcome to Virtual Investor Conferences. On behalf of OTC Markets, we are very pleased you have joined us for our quarterly Small Cap Growth Virtual Conference. Our next presentation is from Global Crossing Airlines. Please note you may submit questions for the presenter in the box to the left of the slides. You can also view a company's availability for a one-on-one meeting by clicking Book a Meeting in the top toolbar. At this point, I'm very pleased to welcome Ryan Gopal, President and Chief Financial Officer of Global Crossing Airlines, which trades on the OTCQB venture market under the symbol JETMF and on the CBOE under the symbol JET. Welcome, Ryan.
Great, thank you very much. As you said, my name is Ryan Gopal. I'm the President and Chief Financial Officer of Global Crossing Airlines. I've been with the company since day one, so I have the advantage of having seen everything since we started in February of 2020 and started operations in August of 2021, flying with our first aircraft. I'll be happy to walk through the story and kind of give you an idea of who we are and what we've achieved since we started. Of course, we would start with all the disclaimer language with regards to forward-looking information and estimates. In the essence, please ensure you review the risk statements in our filings and do your own diligence as you go through this process. Who are we? Global X, as we're referred to, as the fastest growing charter airline in North America. We believe we set the standard for on-time performance and reliability. Since we've started, we've consistently proven the strength of our platform, the resilience of our business model, and our ability to grow demand in the narrow-body charter market. We believe we have a strong foundation that is continuing to scale, and we're starting to see those results. Looking at our timeline and milestones, as I mentioned, we started in February 2020 with an idea. It took us through August of 2021 to receive our certification from the FAA to start flying, where we started with 2 aircraft. And since then, we've consistently grown the airline and the business by adding aircraft, adding customers to where we are today. As we are today, we are effectively at 19 aircraft. As of today, over 700 people. Over the last 12 months, and I think we'll talk about this later, we've operated in multiple countries to multiple different cities. When we talk about how big of a market this is, the charter market in the United States, we operate both on the passenger side and the cargo side. We believe it's a $10 billion US passenger and cargo market, and we believe it's a $9 billion revenue opportunity, of which in 2024, we had $223 million. And one of the advantages of operating an airline and operating the assets that we operate is the great things about aircraft is they can move. So not only are we embedded and centered in the US market, we also can compete in the global market, which is multiple magnitudes larger than the US market on its own. One thing to really make sure we clarify is most people think of airline, they think of a scheduled service like a Delta Airlines. What we do is we operate under what's called an ACMI model, which is called Aircraft Crew Maintenance and Insurance. And it's a fundamentally different model. The way to think about scheduled carrier is really, versus us, is really it all comes down to risk and risk profile and the kind of risk we take and the kind of risk we do not. So the things we do not take, for example, in ticket risk, we sell the whole aircraft. So one passenger being on our aircraft is the same as the aircraft being completely full. On the fuel cost, we do not have any exposure to fuel cost. It's a pass-through to our customers. Crew cost, our costs are passed on to the customer. When it goes to billing, there is no compensation for delays. Our customers pay by the hour. So like, for example, if our flight takes 2.5 hours versus 2 hours, that's billed to the customer. So we're a by the hour, cost plus kind of de-risked operation that operates aircraft, which makes it's a much different way of thinking of than a scheduled airline. And so when you think about valuation metrics, when you think about risk profile, when you think about opportunities, we believe our model is unique to the United States. It's not unique globally. It's unique relatively to the US to be done at this size of scale. And we think it's a pretty great opportunity for investors to participate. Again, what's the difference? When we do invoice our customers, we do it on 2 different metrics. We do it on ACMI and we do it on charter. So an ACMI is when we would provide the aircraft crew and maintenance, whereas a customer would assume fuel, demand price risk, landing fees, airport fees, and other operational fees. Charter is we would provide a whole price to the customer. Sports teams commonly use this, where we'll say, okay, it's ACMI plus fuel plus ground handling, but that's done on a cost plus basis. So we don't take risk for that as well. So from our benefit, it's all about risk management, about risk mitigation, and so which allows us to kind of launch an airline with assets this large with relatively less capital. In order to launch a scheduled service, a large one, as you can imagine, sometimes takes tens, hundreds, if not billions of dollars to get to scale, whereas a charter airline, you can get there much faster, and that's really how we've approached this business. As we've talked about, where we fly, we can go where our customers want us to go. We're not tied to a route. We're not tied to 2 destinations. Since 2021, we've operated to 66 countries and 404 cities, which is probably as diverse and expansive as you can see anywhere in the world and with any kind of airline. So one of the things we have focused on is adding our bases. So we're originally based out of Miami. We've also established bases in Alexandria, Harlan, and Mesa. And what that allows us to do is get us closer to our customers, and it opens up our available market by having aircraft closer to where the customer needs to be. We're going to continue to do this. We're going to continue, and with each base, you get more efficiencies and you're allowed to operate more hours. Now, when you think about what's our revenue driver, number of aircraft is clearly our revenue driver. It's probably no different than a restaurant with a number of stores, and our key metric is number of aircraft. So our goal is to continue to add to the aircraft. At the end of 2024, we had 19 aircraft. Our goal is to grow about 20% a year. We should be doing that in 2025, and then continue to add 4 to 5 aircraft a year for the next several years, which I think will drive significant revenue growth, continued revenue growth that we've seen with a 99% 4-year CAGR since we started in August of 2021. When looking at our financial statements, our Q1 revenue was up 24%, with EBITDAR up 2 times to 20 million. EBITDAR is a key metric that's used in aviation, simply that normalizes for the type of ownership structure. Our aircraft are all leased, and so which means all of our aircraft cost for the owning of or operating the aircraft runs through R, which is rent. Whereas if you owned your aircraft, it would run through depreciation and amortization. So in order to compare one airline to another, you would really want to compare us on an EBITDAR basis. So in Q1 2025, 66 million in revenue, 20 million of EBITDAR, operating 7,500 block hours. I mentioned block hours because that's really our unit of metric. That's billable hours from our perspective. We bill on a block hour basis. We ended the quarter with 10 million of cash and equivalents, 19 aircraft. And really, another key metric is how many hours per quarter are you flying each of your aircraft? And in Q1, that was 442. And as we look through kind of the growth of EBITDAR, we did go through a pretty rapid expansion in Q4 of 23, Q1 and Q2, from 10 aircraft to 16. And when we say aircraft equivalents, that is aircraft net of aircraft down for maintenance or heavy maintenance. So in Q1, we had 16.7 aircraft available for flying. Our EBITDAR per block hour, which is kind of how much revenue we're making per block hour, there is a certain seasonal component to what we do. But again, that's something we're also growing as well, and it translates into overall EBITDAR for the company. So, like we said, this is advantageous as we're seeing stuff going up to the right, which is what you want to see in a growth company, and we're continuing along that trajectory. Again, material growth. If you look at our revenue growth from 14 million in 21 through 224 million in 2024. And you would look at our EBITDAR, which has gone from 4 to 5 to 20 to 60. And then you can kind of pair that with Q1, where we did 66 million of revenue and 20 million of EBITDAR in a single quarter. And our goal is to kind of keep growing that. And that's, like I said, the power of the platform that we've created that we're really excited about. And really, the key driver of profitability of growth is just to add aircraft and keep executing as we go through. We have multiple avenues to drive growth and profitability. We're expanding our fleet by 20% at the end of 2025. We're improving utilization by emphasizing high margin ACMI business. The reason that's kind of material is most ACMI kind of business tends to be higher commitments and more utilization per hour. We did benefit from a large competitor who had over 350 million of annual revenue exiting the market in 2024. Which definitely helped drive a lot of our growth in 2024 that we're continuing. We've recently signed government contracts to account for about nearly 50% of our revenue, which provides consistent, predictable, and reliable foundation of revenue. And when we look in Europe, Europe is a 600 to 700 aircraft market. It only currently represents 5% of our revenue, but is a long-term growth project for us as well. When you think about the key investment highlights and what we kind of focus on, we are the fastest growing charter airline in North America. Our financial profile and balance sheet continues to get stronger with every month and every day that we operate. We believe we are taking advantage in the current market, and we sort of hear about it with the engine issues as they relate to the JETMF issues, and then the MAX delivery issues and supply chain issues. We believe aircraft demand will outpace supply for the next 4 to 5 years, which is really plays into our key market. And again, the new management team, we really have revamped the management team starting in Q1 of last year, of committed to profitability. I think when you look at the metrics we've taken and the drive that we've really taken over, we've really talked about what do we have to do to focus the business on narrow body charter? How do we take what our platform is, which is highly scalable, and really focus on what we do that makes money, not waste ourselves on initiatives that do not, and grow the EBITDA, and we're starting to see those results. And so with that, I try and keep these kind of the first part pretty brief and focused on what we do. I see we've got a lot of questions, which I'll jump into now. But I want to thank everyone for listening. And then I think the next step is I'll just sort of jump into questions. Going through here, the first question, are you operating in passenger and cargo markets, and who are your typical clients and level of repeat business? So yes, we operate in both the passenger and cargo markets. We currently have 15 passenger aircraft, 4 cargo aircraft. On the passenger side, it's a pretty broad mix. I'd say about 40 to 50% of our passenger business right now is U.S. government, and that's highly repetitive, and we've been actively working with them and growing that business since September of 23. I'd say another chunk of our business is college sports. We're one of the largest college sports charter operators in North America. We see about a high 90% repeat rate year over year with basic teams that we operate with. A lot of it has to do with the quality of our product. We have the youngest fleet. I'd say we have the highest reliability in North America as it relates to, and we're pure play charter operators. There are other airlines that we're all aware of, the big ones, who do some charter work, but it's not their core business and it's not their kind of sole focus. And so I think our ability to tailor our business to the demands of charter is a key differentiator for us. We also operate for other airlines. We operate for tour operators, and we also operate in Europe with key clients in Europe, which we have about 3 aircraft going to Europe this summer. So our revenue stream and who we work for is pretty diverse on the passenger side. On the cargo side, we operate for several operators. We only have 4 aircraft in that space right now. And so that would be the major package carriers, charter brokers. And again, on the charter side, we don't sell by the pound, which many do. We sell the whole aircraft. So we'll work with a consolidator who has a route that they want to fly, and we'll fly the route for them. But we don't take the risk on how much cargo or how many packages they have in there. The next question that jumped out was, what are the drivers of your growth? And you see the same drivers over the next year. I think a key driver for growth is a lack of supply. I think we have a differentiated product. I think there's not a lot of operators who are in the space. And so we think those drivers are still there. I still think, and we've talked about this kind of internally and with our investors and with our customers, we could easily put to place several additional aircraft. If we had them, we could put them to work immediately. There's also significant markets we could expand into that have significant growth, whether it's more inside the U.S. or outside the U.S. So do you see the same drivers? Do you see the same drivers over the next year? Yes, I think we'll continue to see the same drivers over the next year. I think we're going to continue to see demand continue to be strong on that side. And third, how do you avoid the mistakes of your largest competitor? That's something that honestly keeps me up at night the most. I think there's a lot to be learned from our our prior competitor that was in the space. And I think some of the key learnings for myself personally is you need to ensure you keep your fleet young enough. You need to consistently reinvest in your fleet. You need to make sure you do not become over leveraged. I think our prior competitor had 20 times the debt that we currently have for a similar revenue size. And I think you have to maintain your service levels. And I think those are kind of the key areas to avoid the mistakes. So ultimately is maintain a good product, maintain great service for your customers, and don't borrow too much and expose yourself in that side, which I think was kind of a weakness for them. And so, well, I realize I probably talked fast. If there are any other questions, I'd be happy to answer. And I guess if not there, I think I'll just go to, a few more here. Do you have plans to expand your client base? Sorry, there, I was missing the tab that had more questions. Is there plans or timeline to expand your client base beyond the US? I think we're already in that time horizon. And so from that perspective, we do operate in Europe. We do operate for people outside the US currently. I think the demand in the US has been so high, we wanted to focus on our current US customers before going beyond there. So I think the timeline is every year it's going to incrementally grow. Like we have 3 aircraft going to Europe this year. We'll probably grow that to 5 to 7 next year. We'll expand into Central and South America as well. And so I think from that perspective, the timeline will be as we take delivery of aircraft, we'll look to redeploy them and deploy them in more areas. But I think the advantage we have is we don't necessarily have to that right now. And so from that, is Global X APAC a part of Global X or is it a separate company? We announced in December a joint venture with a group of investors to the formation of Global X APAC. So it is a separate company of which Global X has an equity interest in. So I know there's been some stuff on LinkedIn as to some of the stuff they're working on. We're obviously advising and working with them as they look to grow and expand that business. It's in the effect of we do have an equity stake in it, but it is a separate company. When it comes to uplist, I think we get the uplist question pretty much every day. We will uplist when it makes sense. I think, one of the elements of uplisting and moving beyond just the OTC exchange is you want to be big enough, you want to have enough revenue, you want to be profitable, you want to be generating positive cash flow, and you want to have a track record of doing so, which I think we have started to establish and hopefully will continue to establish. And I think as part of that, we would go to uplist. We don't have a date or a timeline on it, but I think that's something that definitely makes sense to go. We don't have a pressing need for capital right now, so there's no upside to doing the dilution. But I think there's an opportunity to uplist. I think there's an opportunity for that, and I think we've been saying that for 4 years, and we'll do it when it makes sense. Thoughts on valuation? What are the catalysts for a revaluation of JET? So I think one of the tough parts of being on, considered a microcap or being on a OTC exchange is most of the companies who are in that stage or on that valuation or catalyst day are tied to something like getting certification, getting a well drilled, getting a patent trial approved. And that's just not who we are, right? We have an established, growing, effective business that isn't really dependent on a government approval. It's not necessarily dependent on the delivery of any one single aircraft. I think the catalyst for revaluation, and when I was asked this question before, is earnings. Is at some point, our earnings will be valued like a going concern entity that's generating profit and positive cash flow with a significantly high growth rate, and investors will decide when they'll revaluate JET versus the way they're valuing it today. So honestly, the share price and investors value it. I don't have control over it, but what I can control is our ability to perform against our targets and ability to get more profitable, which is effectively what we're doing and is my key focus. So When that becomes a catalyst for investors is anyone's guess. But eventually you would expect, if you generate positive numbers, you will get valued the way your peers are in the market, and we look forward to that date. So with that, I think that answers all the questions. I think with that, I think we wrap it up. Thank you everyone for joining. If you have any questions, if you want to do a one-on-one, I think there's an opportunity to do that as well. And we'll end it there. Thank you.